You've probably experienced this situation before, where the price suddenly reverses direction even though all the indicators are still giving good signals. Or maybe you've already entered at a spot that looks ideal, but the market ends up moving in the opposite direction and you hit your stop loss. The question is, why does this keep happening, even with setups that seem perfect? The answer often lies in a classic concept that professional traders still rely on to this day, which is supply and demand. So, in this video, we're going to break down supply and demand in detail. Not just the theory, but also how to identify the key levels that are actually used by big players, what the characteristics of a valid zone are, and most importantly, how we can take advantage of these zones to scalp accurately and efficiently, even in a market that seems random. If you're serious about improving your entry accuracy and learning to read the market more objectively, you definitely need to watch this video until the end. Okay, now let's start by looking at the basic concepts first. Supply is a zone where there is significant selling pressure. This usually happens because the price previously went up too high and market participants start taking profits. Meanwhile, demand is the opposite zone. It's where buying pressure starts to come in because the price is considered cheap and attractive to buy. Supply and demand in this context are specific zones that indicate the activity of large institutions, or what's commonly called smart money. Now, these are the zones we can detect on the chart if we know how to read them. Why is this important? Because price movements in the market don't happen randomly. Prices often move toward or away from those supply and demand zones. If we can identify these zones early, we can open positions and follow in the footsteps of smart money. And remember, this isn't about predicting the future, but about reading the market's reaction to zones filled with buying or selling pressure. Now let's move on to discussing the typical patterns on the chart that can indicate the presence of these zones. We're going to talk about 4 main patterns. First, let's start with rally base rally, or RBR for short. Here, rally means the price is moving up strongly. Then the price pauses and forms a base, indicating that buying and selling activity is still balanced. After that, the price rallies again, continuing its upward movement. Why is this called a demand zone? Because the RBR pattern shows that after a consolidation phase, market participants, especially big buyers, start to enter and add to their positions. They accumulate in the base area before pushing the price even higher. When you see the RBR pattern form, where the price rises, consolidates briefly, then rises again, there's a high chance that a strong buying reaction will occur when the price returns to that area. And this is the moment when we get ready to enter a buy position. Next is the second pattern, which is drop base rally. It starts with the drop where the price falls quickly, then the price consolidates at the base, indicating that the big sellers have run out of steam. Then the price suddenly rallies quickly, signaling that big buyers have taken over and triggered a reversal. This is often referred to as a strong demand zone, because major buyers enter at levels they consider too cheap. For example, let's open a real gold chart. Notice the area where the price drops sharply, that's the drop phase. Then suddenly the price starts to slow down and move sideways, and this is the base phase. Not long after, an impulsive bullish candle appears, and this is the rally phase. The base zone between the drop and the rally is what we mark as the demand zone. Why is this zone important? Because when the price returns to this base zone, there is often a strong buying reaction, and it can even become the starting point of a major reversal. Now let's switch to the other side, which is the supply zone. If the RBR and DBR patterns represent demand areas, then the drop base drop and rally base drop patterns will indicate where the supply areas are located. First, the drop base drop supply zone. The first drop shows that the price has already fallen sharply due to previous selling pressure. When it reaches the base area, the price pauses and consolidates, indicating that the selling pressure is taking a temporary break. Then the price drops again with strong momentum. The drop base drop pattern indicates that before the price drops further, smart money has set up distribution in the base area. They might be offloading positions from retail traders who are still optimistic or those who are buying because they think the price is already cheap. For example, let's open a real Euro-USD chart. Look at how the price previously dropped sharply. This is the first drop phase. Then the price starts to slow down and forms a small consolidation. That's the base phase where distribution happens quietly. And finally, the price drops again with even stronger pressure. This means the big sellers are coming back in to continue their move. The base zone in the middle is what becomes the supply zone in a drop-based drop pattern. Just like a demand zone, the drop-based drop zone can be used when the price retests that area. We just need to wait for the price to rise close to the zone, then watch the price action. If there are signs of rejection, that could be a high-accuracy sell entry opportunity. Lastly, there's the rally-based drop pattern. It starts with a rally where the price rises quite high, then consolidates at the base, indicating that the big buyers are starting to decrease. After that, the price drops quickly. Rally-based drop is a signal that after a strong rally, the base zone at that position is a supply distribution area, where major market players are offloading their buy positions. When the price touches or approaches this base area again, there will be a lot of selling pressure pushing the price down further. Now we know how supply and demand can form through price patterns like rally-based rally, drop-based rally, drop-based drop, and rally-based drop. But keep in mind, not all zones have the same strength. Some zones may look valid at first glance, but turn out to be easily broken through. And there are even zones that seem ordinary, but actually become very strong reversal points for the price. So in this section, we'll discuss three main ways to validate whether a supply or demand zone is truly high quality, has great potential, and is strongly supported by market structure and logic. The first characteristic of a high-quality supply and demand zone is that the zone has never been touched or mitigated by previous price movements. Why is this important? Because the greatest strength of a supply or demand zone usually appears when the price returns to that area for the first time. At this moment, there are often still institutional orders that haven't been fully executed. They might not have finished buying or selling in large volumes, and when the price comes back to that zone, it can trigger a very strong reaction. And the fresher the zone is, the higher the chance that the price will bounce or react sharply from that area. But if the zone has been touched multiple times, it means there's no more liquidity in that area and its strength starts to weaken. The second characteristic is a strong move away, or the price leaving the zone with force. A valid supply or demand zone is always followed by an impulsive move when the price exits the base. Not sideways or doji, but a candle with a large body. This signals the aggressive strength of institutions pushing the price away from that zone. And one of the visual signs of this impulsive move is the appearance of a fair value gap, which is a visible gap between candles that shows an imbalance between buyers and sellers. If you see a large candle appear along with a fair value gap as the price leaves the base zone, that's a strong signal that the zone is being used by smart money to execute large orders. On the other hand, if the price leaves the base with only small candles or just a corrective move, it's very likely that the zone has a low probability. The next characteristic of high-quality supply and demand zones is that after an impulsive move, there is usually a break of structure or change of character. This is important because a zone that truly works doesn't just cause a brief price bounce, but actually changes the direction of the market structure. So these are the three main filters to make sure you don't just enter a trade simply because the supply and demand zone you've marked looks good. Now that we know how to validate high-quality supply and demand zones, it's time to get to the part you've all been waiting for. How do you take advantage of them in a precise and efficient scalping strategy? The strategy we're going to discuss uses a multi-time frame approach, which means combining analysis from both higher and lower time frames so we can enter the market with a strong context and minimal risk. The first step is to identify the supply and demand zones on the H1 chart. This will be the main time frame for determining the direction of price movement. Next, we'll focus on the supply and demand zones that are closest to the current price. And these zones will be the main reference points for finding entries later on the M5 chart. After marking the zones and the price moves into those areas, don't rush to enter a trade. Let the price move on its own and monitor it as it starts to approach the zone. Here, when we switch down to the M5 time frame, we can see a change in market structure from bullish to bearish, and there is strong pressure leaving a fair value gap as the price breaks through the last structure low. This is a signal that the market is starting to reverse direction from below. Therefore, we will use this fair value gap area as the sell entry zone when the price returns to this area. After the validation is complete and the M5 zone is formed, it's time to execute the entry with discipline. First, enter when the price retests the M5 fair value gap. We will place our stop loss above the fair value gap or above the previous M5 swing high. We can use two methods for take profit. First, based on a static risk and reward ratio of 1 to 2 or 1 to 3, or set the TP towards the demand zone on the H1 time frame. With this method, we can achieve a very favorable risk-reward ratio. By using this strategy, you won't just enter trades randomly in any zone. Instead, you'll really wait for the combination of the larger H1 structure and the smaller confirmation on M5 to get a precise entry point. Remember, calm trading isn't about gut feeling, it's about following the process. And this multi-time frame supply and demand strategy can be your main weapon as long as you apply it with discipline and consistency.